our founder, John Carter, says that being flat is the new spa treatment. So,
I like
and,
that.
and it's, yeah, it really is. The moment you go flat, your mind is just totally clear. You see things as they are. You're completely objective. So, yeah, there's a lot of value to it, especially in this market.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Why trade alone when you can access over 100 years of trading experience right at your fingertips? Simple strategies, proven tools, real-time alerts, and an interactive trading community await. Keep it simpler with Simpler Trading by visiting their website at simplertrading.com and check it out with a $7 trial today. That's at simplertrading.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. On the line, we have Sam Shames back from Simpler Trading. And Sam, we're going to be talking about a lot of different things today. The market's not showing much strength. It's looking pretty ugly out there. But you brought up something ahead of time that I thought was pretty interesting. I was talking about trading for exhaustion versus trading for momentum. You really piqued my interest on that one, Sam. Tell me all about it.
Yeah, appreciate it. So normally as swing traders, and in this market generally, we've been trading a lot more for momentum. So the market has had a lot of momentum in the indexes and the QQQ, the SPY. And when you have that, you can just really trade the breakouts pretty much continuously since March. Ever since the highs, though, we have tried to change our strategies for the most part. So buying those breakouts in a market without momentum, it doesn't really work. So instead, what you do is you flip both the strategy and the psychology. And so instead of trying to buy the breakout, we're looking for instead exhaustion pullbacks so that we can take the next swing higher. So the way that we've done that is we've developed a tool called Ready Aim Fire. And basically what it does is it tells us pretty close to the exact moment when the selling has gotten a little bit too extreme in the short term. And since markets tend to move like sine waves, if you can catch the trough, of the sine wave, you can ride it at least back to the crest. And in a market that lacks momentum, it really has changed the strategies that we've used.
Yeah, so that makes a lot of sense. I was talking with TG a little bit ago about how it's funny. He and I actually had a similar trading experience of the last couple of weeks where I was buying Thursday and Friday last week, and then Monday and Tuesday, and then by Wednesday I was back in all cash because like everything failed, and I was like, "Geez, this is not what I expected here." However, I think if I've been trading more for exhaustion, that may have helped me a little bit more.
Yeah, absolutely. When you do that, it changes the game in that you're already buying after people have gotten really beaten up, right? So you have the folks that are buying neutral to momentum setups. In this market, that's kind of the old modality. So in this market, that's not working. They get dumped out. And then if you can step in after they've been dumped out, I'm not saying the swing will go back to trend necessarily, but you'll catch that next swing and it can be pretty profitable.
Yeah. So what's going on with the market, right? We talked before about we needed the inflation numbers to be adjusted, and the Fed came out and said that they were going to raise those rates or raise the targets, and we expected things like gold, and we expected the market to kind of rally behind that. And since then, actually, both have just like really died, especially more silver than gold. I've been watching that. But what's going on, man? I thought the Fed was here to save us. I thought Jerome was doing his job.
We could argue that. Yeah, it's just that time of the year. It's September. It tends to be the most volatile month of the year, especially the back half of September. So we're actually about to enter it here in the next week. Volatility expectations have really risen, especially towards the election. So a lot of hedging activity dampens the momentum market that we've been talking about. You can't really have that momentum if everyone's hedging and buying puts on the breakouts. And also there was just, we're mostly technical traders, trading off the charts. And on September 2nd was when the weekly trend broke. So the weekly trend is still intact, but it doesn't have momentum anymore. And therefore, if you don't have weekly momentum, then you have to rely on the daily chart, and the daily chart is below the 50, and it's below a couple of key levels. So it's just kind of a point of limbo where you have rising volatility expectations, a broken weekly trend, and no clear direction on the daily.
Sam, this doesn't sound like a lot of good news for the markets.
It doesn't seem that way either. I mean, I actually haven't even gotten into the bigger signals that we're looking at. Not to put anything too crazy out there, but there's actually a scenario that's setting up for October that mirrors 1987.
Okay, well, you can't just leave that one. You got to explain that fully.
For sure. Yeah, we haven't really touched base on that one. So there's a couple of products that I look at to get this this call, if you will. One, if you look at the historical precedent leading into 1987, it's extremely similar to the backdrop that we have now. You had a market that was pushing towards the highs. You had a couple of weeks of decent selling, but still relatively intact. And then the bottom just fell out in October. The signals that I'm looking at to get me there are the VIX, so the VIX, which is the volatility index. If you look at a weekly chart of that, it's created a nice big base, and it has what we call a squeeze. So a squeeze just means compression before expansion. And the compression on the VIX volatility has happened at much higher levels than where it happened in February. So
you're saying levels being like price levels?
Yeah, right.
Okay.
Yeah. So in February, we had a base below 20, and we shot up to 70. Now the base is in the 20s to 30s. So we've kind of based from a higher level. And if we're ready to squeeze out of that, it would imply a return to February levels. The other signal that I look at that's really underappreciated is a product called HYG. Which is high yield.
Hang on, don't tell me. High grade bonds, right? High yield bonds. Mm-hmm, yeah, I've traded that before. I know that one.
Yeah, so that historically tends to be kind of a canary in the coal mine, and we've seen that product significantly start to break down as well. Oh. Not only has it broken down, but it has so much reverse momentum, if you will, on the weekly chart that the breakdown has a ways to go. The thing with that product is credit tends to lead markets, right? So folks tend to focus on Apple or Tesla and Amazon, and that's fine if credit is good. But if credit, HYG, starts to break down, then that has this feedback cycle into everything. So that's a huge one.
So I'm gonna ask several questions on follow-ups there. So TLT, which is long-term bonds, is showing strength, where HYG is showing weakness. Now, what are the difference in the two of those?
TLT is the government bonds, so it's going to be the highest grade paper that you can buy. You know, AAA government bonds, U.S. government bonds. The TLT is 20 years, and the HYG is also bonds, but it's bonds issued by risky companies. So it would be like the Dave and Buster's of the world, right? They would issue junk bonds. They tend to have a higher yield because it's a much riskier proposition, but in using them as an indicator, when credit starts to sniff out problems, it'll show up in HYG. So it shows up in HYG first, and then it'll show up in the stock market probably within about a week or two.
Do you think it has shown up with Nikola, the electric car company? Looks like you know what I'm talking about.
I do. Yeah, the unfortunate hill push.
Yeah.
Scenario. Yeah.
All right. So let's give the audience a little backstory on this. So Nikola, which is honestly just, I'm gonna have to bite my tongue on that one. The naming of it to be a competitor for Tesla just annoys me, right? Like, you could come up with any company name in the world, and you want to go with Nikola to compete with Tesla? Come on, how unoriginal are you? But then the stock got really excited and grew a fair amount when it was announced that GM and Nikola were going to be working together to produce like 18-wheeler type vehicles. And then it turns out that there may have been some shady dealings going on inside of Nikola, and maybe this is hilarious to me. Maybe the truck stunt where they're driving the electric vehicle may have just rolled down a hill instead of actually being driven. Sam, what in the world's going on here, man?
It's that kind of market. I mean, it's what happens in the later stages of a market, right? You know, you look back at the .com and we all shake our head at all the craziness, the Pets.com of the world. This is our Pets.com, essentially. Yeah. You know, we're living in the moment, so we're not exactly fully aware of that, but I'm sure 5-10 years down the line, we'll look back and think, what the hell are we? What were we doing here?
Yeah, I saw a YouTube video and I thought the presenter did a good job of explaining the history of Nikola up to this point. And the founder, now obviously, disclaimer, I don't know everything, but went through several companies and in that time committed potentially fraud on all of those several companies. And this is just the latest in his string of potentially fraudulent behavior, which I find really concerning, right? We're trying to potentially put people's lives in the hands of somebody that may not have the best interest in mind. Like you look at Tesla, right? I think Teslas are great. I'm interested in buying the Model Y. I think that'll be a lot of fun. I can't wait to experience what like sub 3 second 0 to 60 acceleration would be like. And for relatively affordable, right? We're not talking Lamborghini territory for prices. We're talking like $50,000-$60,000 on a midsize SUV. I mean, you can go out and buy a new Tahoe for a hell of a lot more than that. But the fraudulence, like you're talking about, the Pets.com bubbly aspect of things does concern me.
Yeah, I mean, it concerns me as well. At the end of the day, the Fed will be responsible for that. When we look back on it, they've kind of enabled. You wouldn't be able to have all this excess if the Fed had not kept rates this low. Basically keeping rates this low allows zombie companies and fraudulent companies to kick the can perpetually.
Oh, really? How would that work?
Well, it just allows them to roll their debt. So, if bonds weren't so close to zero, their borrowing costs would be significantly higher, and they wouldn't be able to roll their debt because nobody would loan the money.
And then they wouldn't be able to make these non-functioning trucks roll down hills.
Exactly. Yeah. Yeah. That was something.
So what can we do to change our strategies going forward, right? Are we looking to now short stocks, or are we looking to try and catch these bounce moves? And if we're looking to catch these bounce moves, I mean, we got to be precise on our entries here.
Yeah, you really do. It at least in the current paradigm that I see, it's really become a lot more of a trader's market. So the idea of just buying something and holding it and getting paid off from the trend, I think, at least for now, has been put on pause. So the adjustment is a lot more, like we spoke about, exhaustion buys in good charts like Nvidia or Square, things like that. Sizing smaller, obviously, because the market is so choppy. So you can catch big moves, but you don't need as much capital, and being faster. Yeah, so just kind of going back to the first point, not getting married to anything because the overall market has lost trend.
Yeah, I've seen, I mean, you make great points, and I've seen several, quote, YouTube financial gurus who talk about, I'm going to buy this stock, waste management. Waste management's awesome, right? People are always going to have trash. And then, I don't care what it can go up, it can go down. I don't care. I'm going to hold it forever. Dude, are you Warren Buffett? For real? Like, do you actually plan on holding this stock for 60 years? Like if it's below its 200-day moving average, why in the world are we even talking about it, right?
Exactly.
Yeah.
All these people that say they have that patience don't have that patience.
Or they don't actually trade with money. I mean, that's the difference between you and I, right? Well, not between you and I, between you and I and them. We actually use money in our trades and can attest to saying, I'm not going to hold anything when it's just dying. Why would I do that, right? Not for the fact that we can move on to a new trade, but I had one podcast guest on, and I'll never share who it was, but like you can see it in my face when he's talking about how he's going to hold it forever, and I'm like, why? Just get out. And he's like, no, I mean, it's pretty deep in the money. I'm not going to be able to get out of this one for a winter. And I'm like, okay, just get out, like deal with it.
Yeah, so, I mean, opportunity cost is a thing.
Yeah. I mean, you're holding up capital even where you could be making other trades, but instead you're going to just hold on to this loser that's not working for you. I don't know.
But folks underestimate the value of mental capital. Not only do you have your money tied up, but then you're thinking about this whatever stock is churning about.
Okay. On that point, right, mental capital. Like I was saying last week, I was buying Thursday, Friday, Monday, and Tuesday, and then Wednesday came along and everything just broke. And my first thought was, man, this let's give it a couple hours to see if it bounces or whatever. But then I'm like, no, just like cashed everything out, immediately went flat. And I'm like, oh, I feel better. I feel a lot better. I don't have to think about this anymore.
Exactly.
There's so much to the mental capital part that you're talking about. That's right.
Yeah, I mean, our founder John Carter says that being flat is the new spa treatment. So
I like that.
and it's yeah, it really is. The moment you go flat, your mind is just totally clear. You see things as they are. You're completely objective. So yeah, there's a lot of value to it, especially in this market.
Yeah, right now for sure. Well, Sam, I appreciate the chat today. I feel like this is giving our audience some things to chew over right now. That the momentum plays maybe need to get put on the shelf for a while. Maybe try some exhaustion plays. But
and also, I'm sorry to interrupt you, but just
sure.
also to be really cautious going into October, right? Don't even if we bounce on this thing from a technical point of view, which is how we trade, you can bounce and it'll feel good, especially in things like Amazon because it'll bounce $150, $200. But the signals for October are lining up. So just to present them again for your viewers, it's the VIX, which is volatility, HYG, which is high yield bonds, and international markets. You can look at take your choice. And lastly, the dollar. So if the dollar gets a rebound here, it's been being sold off for a month or two. If it gets a rebound here, that's going to put pressure on stocks as well.
How do you track the dollar? Do you go, what is it, like UNG or something? No, that's natural gas. Starts with a U. I can't remember. What do you use to track the dollar?
You're probably thinking about the ETF. It's UUP.
Yeah. UUP. That's what I'm thinking of. You don't track that one?
You can use that as a trading vehicle if you want to go long the dollar. But the way to track the dollar is usually going to be with either the DXY or just something like dollar euro.
Well, that's what I was thinking. I'm going to add these to my watch list for viewing sake. So DXY. And I was like, which one of these do I go with? So I remember I looked at UUP, but it's been a hot minute, man. I'm talking like 4 years ago since I've even looked at it. Okay, cool. So make sure you add VIX, HYG, and DXY to your watch list because that's literally what I'm going to go do right after this call with Sam. So Sam, I appreciate that, man.
Good stuff.
I've written a short guide on how you can use the Triple Stock Profit system. It's the secret weapon every investor needs right now to change your financial future. And you can get it for free by visiting triplestockprofits.com or in the links below. Also, if you want to join a community of traders just like you can get free access to the elite membership that has even more resources to help you trade faster and trade smarter.
Well, hey, again, thank you for your time. Where are we going to send people at today? Simplertrading.com/Sam. I don't know why I didn't think of that sooner. That's where we're going today. So appreciate your time, Sam. And make sure you guys head on over to simplertrading.com/Sam to learn more about Sam and to get, some more information that can help you with your trading. So Sam, I appreciate your time, man.
Yeah, absolutely. Good to be with you, Chris.
Yeah. And thank you guys for tuning into today's How to Trade Stocks and Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode.